Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring Live. Today is Saturday, June 22nd, 2019, and I have received quite a few emails recently asking me if there was any information or books that people could read about my V1 and V2 entry signals that I use in my live trading. And by the way, if you haven't been able to visit us during our live trading, it's Monday through Friday during the last hour of the market on YouTube. So it's during the last hour of the market, whatever time zone you're in. And if you haven't had the opportunity to come check it out, please do. I think you'll find it a lot of fun. We analyze charts each day. We go through my current positions, why I got in them, or when I got in them, why I got in them, how I'm going to manage them going forward. And then we look for trades every day. So last hour of the market, Monday through Friday, if you can make it. But like I said, I've had several emails just recently asking me, is there any information or any books I can read about, so I can read more about these V1 and V2 entries. And, I wrote the people back and I said, I learned this from Kerry Lavorne. He's a trader. He's an excellent trader. He's a trading partner with Dr. Alexander Elder and a business partner as well. They run a couple websites together. But as far as I know, Kerry has not written any books on this. I studied with him one-on-one for about a year, and this is where I learned these entries, and I got to tell you, I am very glad that I did. To me, it's kind of the secret sauce of my trading. I use other methodologies of trading, but the V1, V2 entries are such an integral part of getting me triggered into a trade that boy, I'd be lost without them. So I can understand people are very interested in them. So with that being said, no, I don't believe Kerry has written any books, but he does have a website. He does offer private one-on-one coaching and consulting like he did with me. And so I think you can see on the screen here, this is his website. It's www.kerrylavorn.com. That's KerryLovvorn.com. And I'll put a link to this website in the description of this video. So in case you'd like to contact Kerry, the other site that he has along with Dr. Alexander Elder is called spiketrade.com. And those of you who haven't heard of Dr. Alexander Elder, he's written one of the most famous trading books ever, The New Day Trading for a Living. But between these two guys, these are two powerhouse traders and educators. So Spike Trade's a great website where you can go and they have some professional traders there. They make their picks every week. They have webcasts, webinars, and teaching lessons. So, and that's spiketrade.com. So between the KerryLavorn.com website and the spiketrade.com website, I'm sure you can sign up to do some kind of classes, to learn more about V1s, V2s. But in this video, I'm going to go through specifically again how I use them. And so hopefully that will be of help to you going forward in the future. So, all right, I'm going to turn the webcam off because I'm going to be looking at the other screen. It seems like it's a little rude to look away, but I will come back and say goodbye after I'm done with this presentation. So hang tight and let me turn this off here. All right, and then we'll put Katie and I back there, and let's get into it. So let me first of all just go through the basics of a V1 and a V2. So a V1 happens when the current bar goes below the prior bar by at least 1/4 ATR. Now, what is an ATR? Well, an ATR, you can see the channels here. Here's the first one, here's the second one, here's the third one. This distance, these are all equidistance here, but this distance from here, this distance from here, that is 1 ATR. So a half of an ATR would be right here, a quarter of an ATR would be about right here. So this is a really good example of a V1 entry where this bar goes below the previous bar by at least 1/4 ATR. And you can see in this case, it's close to a full ATR, right? So, so intraday it goes below and then it closes above the previous day's close. Now, you can use this intraday if you wish, just my personal preference. I like to do all of my buying on a closing basis because I feel like the prices at the end of the day are the most valid, but you know, it's up to you. You can use them intraday, you can use them at the end of the day, but I tend to use them at the end of the day. But more importantly, what's going on here is that yes, we have a V1, but V1s can happen all the time. They happen all the time. What's important is that you take a V1 in the proper context of what's going on with the chart. And the best V1s are when you make a higher high from the previous range, you make a higher high, you come back down into the value zone or between the 1 ATR channel and the -1 ATR channel. See, right here in the middle is the mean. So as it gets further away, it can tend to run out of gas, especially when you get up closer to the 3rd ATR channel or down the -3rd ATR channel. So I like to trade, and this is how Kerry taught me. He taught me to, you know, the best V1s, V2s come within the channel, the 1 and the -1 ATR channel. So it's important to realize this, and the best ones are when you have an up move, you make a higher high, you come back down into the value zone, and then it's also very important that the price then moves sideways for a couple days at least, showing that the selling pressure is gone and that it has found some type of stability. So you can see this moves up, moves down, moves sideways, showing some indecisiveness one way or the other, and then the bar spikes down and reverses and closes there. So for me, I would absolutely 100% buy this because it fulfills my requirements of a higher high, a move back down into the value zone or the 1 and -1 ATR channels, some sideways movement, a spike down and reversal. And so what's so important about this spike down? The importance of the spike down is that the market is going down and testing these lower levels. But by virtue of a V1 or a V2, it goes down and then reverses back up, meaning that the market tested these levels down here, did not like them, and reversed back up. So you just had a recent test of this area and the market did not like that. So, you know, moving forward, it's nice to know that just recently the market just tested that. It doesn't mean it's not going to go back down, but there's, you know, it already did just test it. So, you know, these V1 and V2 triggers are so important to my trading. Now, for instance, if I would have bought this right here, generally a good, oh, and I should say also, do you see how we washed out the -1 ATR channel also and then closed back up? That's another good test, is that we tested this 1 ATR channel. So keep that in mind. Look for V1s, V2s that happen under the 1 ATR, the -1 ATR channel if you're going long, and moving back up, back into the channel on a closing basis. So this is a V1. Let's take a look at a V2. So a V2, oh, sorry about that. So a V2, you can see we have the same requirements, right? We have a nice upward move. We come back down into the channel. We move sideways for more than a couple days. we spiked down. So this is the spike down day. If this day would have closed above this day's close, it would have been considered a V1. But if a V1 does not close above, or when you have this pattern and does not close above the previous day's close, you're still allowed, if it works, or if the price closes back above day one's close on the third day. So here's day one, day two washes out day one by more than a quarter of an ATR, and then day two closes above day one. So that's the difference between a V1. A V1, it washes out and closes back above on the first day. A V2, we have the pattern, upward movement, sideways, spike down, but this did not close above, but the next day closed above day one's close, and so that is valid. Now, do you see how we're getting close to the 1 ATR channel up here? You know, a rule that I have is that if the V1 or the V2 triggers above the 1 ATR channel, unless there's something else going on with the chart that's positive, I just let it go. Because like I said, the best entries come within the channel. As soon as you start getting out of the channel, then you know you're swimming uphill a little bit. I tend to target like the third ATR channel. I like to get a V1, V2 here in the middle and target a third ATR channel. Or if I'm short, target a negative third ATR channel. And the other requirement that is very, very important is I want you to look at the ATR distances here, from here to here, from here to here, right? On a V1, if the day one bar is larger than 1 ATR channel, I just pass on the trade, because what it shows, like this bar here, look how big this bar is. It's certainly larger than this, right? It's almost 2 ATRs. If you have a bar that is larger than 1 ATR, what that's showing you is that there's a lot of, to the downside, there's a lot of supply coming into the market, because an ATR channel is the average range based over 20 days. So, you know, this bar here is within 1 ATR channel. This bar here is with 1 ATR channel. These all are, but then this one's a huge one, right? It's showing that there's something extraordinary happening. It's not just the regular size of a bar that you would expect in just a regular day of trading. So if you have a big bar down, if this were a V1, it's not a V1, but just for instance, I would not get in front of this large bar. I want to have small bars. I want to have indecisive bars. I don't want to get in front of a bar that's showing me that it's moving larger than normal to the downside. But you can see this bar here is certainly within the range of these ATR channels. So it's very important not to get involved in a V1 or a V2 if any one of the bars, well, except for the middle bar. This bar is big, right? But it's okay, because that's the washout bar. That's the washout bar. It's up against, it's actually day one of the Trinity. If you know, in a V1 you only have 2 bars, and in a V2 you have 3 bars. But if that day one bar is larger than 1 ATR, I'm just not going to take it. So here's the V2. You can see we moved up, we moved sideways. See how the bars are consolidating. You see how they're not larger than 1 ATR. Means it means a lot of supply is not coming into the market. They're just indecisive bars, and those are the kind that I want to take. So again, real quick, and then I'll get on to some other examples. A V1 is where you have the previous day's bar that is not larger than 1 ATR. Ideally, it's within the 1 ATR channel. The next day washes it out to the downside, reverses back up, closes above the bar, and it's best if it closes within the 1 ATR channel. And it's also nice to have a higher high preceding that. A V2, same requirements. We want, you know, a higher high, a move sidewards, a spike down, a reversal. This bar not being larger than 1 ATR, you have at least 2 days of moving sidewards, and then a move back up and close above within the channel. Now, there's varying degrees of V1s and V2s, and sometimes I will take a V1 or a V2 that I may not have taken if all it was a V1, V2, but if I have some other contributing factors like a double bottom with the divergence, a rejection of a major moving average, I may reduce my requirement slightly on what the V1 or V2 looks like, but it's being made up on the other side by other indicators that are going my way. So anyway, okay, so I hope that makes sense. But what I really like about the V1s, V2s is that you will not get into the trade unless it triggers you into the direction that you want it to go by default. You'll only get into the trade if this formation forms this little V formation, right? That's why it's called a V1 or a V2. So let's go through. I've marked a couple here on my charts. And let's see here. Now, the previous example I showed you is we had a higher high, then it came down, moved sideways, spiked down, reversed up. And that's good because, that's if you're in a trend trade, if you're moving up, you're basically buying dips. But you can also buy these when they come out of a downtrend, haven't really shown you that they're going to be in an uptrend yet. But a V1 or a V2 will form a higher low from the previous low, and that's important. I always like to buy either breakouts or V1s and V2s when they happen from a higher low perspective. And the reason why is that when people buy these lows, see how this is a lower low than here? When people buy these lows, a lot of times they're just trying to buy a quick dip. And when it gets back, when it moves 3 or 4 or 5 days their way or back into the channel, they're looking for a place to exit. Maybe if you bought this here at the 30 RSI and then we get up to the 50 RSI, people are looking for an exit. I do this all the time. I buy these lower lows and then I sell them when they get into this range. Well, this causes the stocks to have some supply coming in, right? They're selling coming in. And that causes the stocks to go back down. And a lot of times they'll go back down and make a lower low. But if they're strong enough to just come down for a couple days and then move up, especially with the V1 or V2, I really like those positions because the people that bought here, sold here and here and here, now they're out of the equation. Now it allows for easier movement because you have one whole group of buyers. So let's go through this and see if we can find the V1 or the V2 right here. Well, here it is, right? We come up, see how we go into the channel? Now, do you see how day one here washes out? I'm sorry, day two, the washout bar washes out day one. So if this would have gone above day one's close, it would have been a V1, but it didn't. So we have the ability for day two to happen. Well, here it is. V2 does close. Day three does close above day one's close. So you have day one, day two, day three. Day two washes out day one. Day three closes above day one's close. And in addition to that, see how the washout bar, the day two bar, poked its head below the -1 ATR channel and then closed back above. So that would have been an excellent trade. This is a higher low V1. The people that bought here, when it got up here, they sold. Those sellers are out of the equation. Now we have a V2 to trigger you back into the trade, and you can see it was a monster trade. Now, one other little caveat that I do want to let you know: the best V1s and V2s happen when there is no gap on the on the third day here, day one, day two, day three. Do you see how we have a little gap here? Meaning that it did trigger a V2, but sometimes you can trigger a V2, but it comes on a gap from that day. The best ones happen when there is no gap. This is a little gap. This wouldn't concern me. This is a 16th or an 1/8 of an ATR. Generally, my rule that Carrie taught me was that if it gaps more than 1/4 of an ATR, you know how we want it to wash out the previous day's low to be valid by at least 1/4 of an ATR? If it gaps more than 1/4 of an ATR, I generally don't take it unless I have some other corresponding indicators that are telling me it's good enough. We can let it slide a little bit and not be as exact on our V1 or V2 entries because we have some accompanying other indicators. But the best ones are when you do not have a gap. And this one has a very slight gap that wouldn't concern me at all. So anyway, good example of a higher low V1, V2. We make a lower low. We come back into the channel. Day one, day two washes out day one. Day three closes above day one. Now, where would I put my stop on this? I trade a variety of different ways, but if I was just trading the V1, V2 way, generally halfway of the washout bar, and the washout bar is the day two bar on a V2. So on a closing basis, if it closed below halfway of this bar, I would get out. It's basically just telling me that it's not going to work because it shouldn't close below halfway of that bar. But anyway, there's a lot of different exit strategies, but just as a good rule of thumb, a close below the halfway of the washout bar is a good rule of thumb on a closing basis because the closing prices are the best. So that's an example of Apple. Let me show you an example of AMD. So in the live stream, we've been following this one and we passed on this trade. And so I want to show you why we passed on this trade. And based upon what I just told you on some of the requirements, I think you'll see. So, this is good. We moved up nicely, right? Obviously an uptrend. We came down back into the value zone. So that's good. But what are we missing? We're missing the sideways movement, right? I want to see that it's found some support. I want to see that there's no more selling, that it's starting to consolidate. And this one did not show this. It moves up, it moves down, and then it immediately creates a V2, right? Without having those 2 or 3 days of consolidation. So, and the other reason why I didn't take it was here's day one. Day two certainly washes out day one. Day three closes above day one, so that's a V2, but do you see how it gapped, everybody? That's kind of one of the no-nos. If it gaps too much, the markets don't like gaps. Generally, they like to test them. So it would have been better if this would have opened right here at the close or even slightly down and then went up. So this is why I did not buy this for 2 reasons. This was good. We moved up. It's good that we moved into the value zone, but then I want to see some sidewards movement for 2 or 3 days. Then the spike down, then the V1 or V2 entry without the gap. But you can see here's the gap, and you can see, and it moved up for a couple days, but now it's given it back. So, moving forward here, let's look at the bars. Was this bar okay to take the V1 on? Yes, it was, because the height of this bar is within the 1 ATR channel. This one here, if we would have a big move up on Monday, we could trigger a V2, but would it be valid? It'd be right on the line because this bar here, actually to my eye, it does look a little bit larger than 1 ATR. So if any of the bars are larger, or if that day one bar is larger than 1 ATR, generally, unless you have some other accompanying indicators and setups, probably would want to let that one pass. But, I can show you right here because I can manipulate this bar. This would have been a V1, right? On Friday, if this would have happened, but I still would have been concerned about taking this because this day one seems to be larger than 1 ATR. But all in all, you could go ahead. You do have some sidewards movement here, whereas here you move up, you move down, you immediately get that V2, which I don't like. But here you have a couple days of moving sideways, which is okay. The only thing that would concern me is the length of this bar. My software allows me to do this, but I wish I could do that in real life, right? But that is why I didn't take it. It gapped to make the V2, and we did not have any sidewards movement. Now, this also works on other time frames. So this is 5 below. This is a really good example. I was actually in this trade, but I got out because of the Fed meeting, but it's such a perfect example for a teaching illustration that I wanted to show it to you again. So these are on the weekly bars, right? So anyway, here we move up. We take out this previous high, we're in a nice uptrend, and then we come back down into the value zone, which is totally to be expected, and it's actually what you want. You want to buy in the value zone, not above value. Well, so it moves up, moves down, but unlike AMD, do you see how we have these 3 days of moving sidewards? So that's what we want. We want to see that the market is going to stop going down and start to consolidate, that the supply in the market is kind of drying up. So we move up nicely, we move back down into the value zone, we moved sideways. 3 weeks ago, this bar stabbed down, took out the day one's low. Here's day one here, or week one, here's week two. Week two closes or goes below week one, washes it out by more than one ATR, or by more than a quarter of an ATR. I mean, a quarter of an ATR is this much. Right here would have been fine, but it thoroughly washed it out, rallied all the way back up, did not close above, so it did not trigger a V1. But again, if the next day or the next bar closes above, that does allow for a V2 entry, and it did not gap up. It actually, well, it gapped up a little, but then it came back down and then closed back above. So this is a good example of a V2 that checks all the boxes. Move up, move back down into value, move sideways for a couple days, stabs down, goes back up, doesn't trigger that bar, but the next bar closes above day one and gives us a V2. Is this bar larger than 1 ATR? It's pretty close, probably a little bit, but in the context of this chart being so perfect like this, it's okay with me, especially it tested the 20-week, it tested the 10-week, the 5-week. So I did have to get out of this trade because of the Fed meeting, so I don't know how this is going to go moving forward, but it's a perfect example of a V2. Move up, move down, or higher high, move back down into value, sidewards motion, stab down, reverse, and it triggered you into the trade. It triggered you into the trade the way that you wanted the trade to go. What would be my stop on this? Probably halfway of this bar. A close below halfway of this bar. All right, let's look at Coca-Cola. All right. So here's an example of why not to take a V1 or a V2. Well, here we make a higher high. That's good. We come back into value. That's good. Here we have a V2. Here's day one, day two, day three. Day two washes out day one appropriately enough in the value zone. But day three does trigger, it, technically triggers a V2. But would I take this trade? I would not. And why? Because it closed above the 1 and -1 ATR channel. Remember, when you start getting up into the second ATR channel, third ATR channel, that's probably where you're really going to run into some inherent resistance to the upside. And also, do you see how it gapped? Maybe that gap, I think it's at least a quarter of an ATR. So I would not take this trade. It is a V2, there is no doubt. But in the context of the chart, it triggers at too high of a level, and you did have a gap. And you can see that was about it. Now, this one here is a little bit of a different story. It moves up. It does look like it made a higher high. It comes back into the value zone. It does trigger a V1. It does trigger a V1 within the ATR channels. It has a slight little gap, but probably not enough for me to not take the trade. The only thing that I don't like about here is that it moves up and we don't have any sidewards movement before the V1 or V2. So as you can see, it would have been an awesome trade, but just from a teaching perspective, the best ones come when you make that higher high, come into the value zone, move sideways for a couple days, giving the market a chance to prove that there's no more supply, and then having to move up. But anyway, this is a good example of a V2 that does trigger, but it triggers too high. This one here, it triggers correctly within the value zone, but you don't have any sidewards movement. So Sometimes bad V1s, V2s work out. Sometimes good V1s, V2s don't work out. But, we want to play the odds and take the best setup that we can have. All right, here's Lockheed Martin. So this was an actual trade that we took during the live stream, where we make a higher high above the 1 ATR channel, above the channel. We come back down, we move sideways. This was the key. See how we move sideways for 3 days here? And then here's day 1, day 2 goes below day 1. Day 1 is not larger than 1 ATR. Remember, that's very important. So it moves up, back into the value zone, moves sideways, stabs down, washes out day 1, closes above day 1's close within the channel, which is the important part. It's not overbought. And we took this trade here, phased out all the way up into here. So this was a real trade using V1s, V2. So this is a good example. All right, MasterCard. Well, this is another real trade that we took just last week in the live stream. And here you go. We move up into an uptrend. We have some selling. It's not violent or anything. Just comes back down. We enter back into the value zone, right? Here's day 1. Day 1 is not larger than the ATR channels. Some people call them Keltner channels. But again, we move up, make a higher high. We drip down into the value zone, into the channel. We do move sideways for a couple days here now. Here's day 1. Day 2 spikes down, tests these prices. The market says we don't like the prices down here, and then reverses back up. It didn't close back above day 1, so it's not a V1. But remember, if the next day does it, that gives us the opportunity for a V2. And you can see it did close above day 1's close. It was still in the channel. We had this nice washout. I bought it here at 260.39, and the next day, boom, big day, right? So this is a real trade, a real actual example of how I use this in real life trading. But it checks all the boxes. Uptrend, move back down to the value zone, sideways for a couple days, spike down, reverse. The V2 triggers me into the direction that I want it to go, and it moves up. So good example there. All right, here is Merck. Again, we're in an uptrend. We move up. We come back down into the value zone. We have 2, 3 days, 4 days, 5 days is fine also, but at least a couple days. Move up. We move back down into the value zone. We move sideways. Here's day 1. Here's day 2. Day 2 washes out day 1. Day 3 closes above day 1's close. Now this one, I'd give this like a B or a B plus as far as the setup, because here's day 1, day 2 washes out day 1, day 3 closes above day 1. It does close within the channel, barely. So technically, on a technicality, it's still legitimate, but it did gap up probably more than 1 ATR. The only saving grace on this trade was that it gapped up. Intraday, it did close the gap enough to be tested and then moved back up. So I didn't take this particular trade, but would I have? Yeah, I would have. This gap would have concerned me, but it gapped up and then it came down tested about halfway of that gap, and then it continued to move up. And then it did close underneath the 1 ATR channel. And you can see that would have been one heck of a trade. All right, here is Philip Morris. This, again, is a real trade. And, excuse me, earlier I talked about sometimes I will let my V1, V2 quality slide a little bit, as long as I do have some other accompanying indicators and setups. And this was one of them. So here's Philip Morris. Obviously, we're in a downtrend here. We've moved sideways. We've really started to make a base. And the sidewards movement, you know, here's the low of the base. Here's the low of the base. A few days ago, we stabbed down, tested the low, closed back into the previous range. We stabbed down, tested the new lows, closed back up into the previous range. Now, I did buy Philip Morris on Thursday. You can see Friday we had a huge day, but on Thursday I did buy it. Now, this technically is a V2, right? The quality is not that high, but from a just technically speaking, here we have a day one. Here we have a day two. Day one does wash out. Day two does wash out day one, not by a quarter, right? That's kind of our requirement, but I took this because I had other things that were going on that I liked. But here's day one. Day two washes out day one. Day three closes back above day one's close. So not a great V1, V2. It did close back up into the channel. I did like that, but you know, this was a good trigger for me. I liked the big picture. I liked the context of this chart. I liked the sidewards movement, the stab down reverse, the stab down reverse, closing back up into the channel. And more specifically, it had been a month or so since we had closed over the 10-day moving average, and we finally did close back above the 10-day moving average as well. So would I take this V2, this quality of V2 normally? No, I wouldn't. But because I like the base, the couple days of stab down reversed, MACD going positive, so that's how I use V2s, not A plus V1s, V2s, but lower grade V1s or V2s if the big picture of the chart I like in addition to the V1 or V2. And I'll use the V1 or V2 to actually trigger me into the trade. All right, here's another example of a V2 that is a low quality V2, but there were other things going on with the charts that I did like, and specifically, you know, it's a good back-tested approach on the QQQs is if you stay out of the Qs under the 200 or the 250-day moving average, and then you stay back in the Qs over as long as they close above the 200 or the 250-day moving average. It's a good back-tested, long-term, quantified, profitable approach to trade the Qs. But you can see I did enter it here on the 4th of June when we closed back above. But preceding, we had 2 days. Here we have a low, day one. Day two, we thoroughly wash out day one. Day three, we close above day one's close. So yes, it is a V2. It's not a high grade V2 because the trigger day of day three gapped from day two. Remember, that's kind of a no-no. We don't want to see that. We don't want to see more than a 1/4 ATR gap. But in the bigger context of the washout of the third ATR channel, the close and immediate close back above the 250 and the 200-day and the close back into the channel, that helped me make my decision. So, but this is an example of a V2, V1, V2, I'm sorry, day one, day two, day three. Day two washes out day one, day three closes above day one. Didn't close within the channel, and had a gap. So this would not be a high ranking V2, but in the larger context of the close under the 250, the close under the third ATR channel, and the close back up above the third ATR channel and the 200 and the 250, and the close below the 30 RSI and the close back above. So I actually did make this trade with the full position here. I'm still in the trade now. So this has been a monster trade. All right, next example. So here's another example of a decent V1 and V2, but I took this because there were other accompanying setups in the chart. But first of all, let's go to the V1, V2. Here's day one, day two washes out day one, day three closes above day one's close. So yes, it is a V2, right? It's not the best V2. It's okay. It closes back in the channel. That's good. It does have a gap, but you know, there's kind of a small nuance here. It did gap up, but then do you see intraday it tested the gap and then closed back up? That's fine. As long if it gaps and then comes back down, tests the gap and then closes back up, it's pretty good. So all in all, actually, this is not a bad V2. The only thing that's going against it, it's coming from a lower low. Generally, the best V2s, V1s or V2s are higher low V2s, or when you're uptrend, you come back down into value. But, so would I have taken this just based upon the strength of this V2? I might have, but what I really liked here is what I have this low, I have a rally, I make a lower low. You see how the MACD readings on this lower low, the red bars here, the red histogram bars are very shallow. The previous lows, they were very deep. This is what Dr. Alexander Elder, and I've studied one-on-one with Dr. Alexander Elder, and he feels like, you know, a double bottom with the bullish divergence is one of the most powerful technical indicators there are. So this was a wonderful trade. This was a real trade, but you know, you have the low, you have the rally, you make the lower low, you have the bullish divergence, the double bottom with the bullish divergence. But all in all, what was my trigger, right? I like the setup, but then I need a trigger to actually trigger me into the trade. Well, this was my trigger, the V2, day one, day two, day three. Day two washes out day one, day three closes above. And in addition, we poked our head down here on this day into a new range and immediately reversed. So it was a really good trade. This was a 14% trade for me. I did enter it here and phased out about up here somewhere. So that was a monster trade. Why did I mark this? Oh, okay. This is an example of a V1 or V2 not to take. Here we are, we go up into, we take out the previous high, we're in an uptrend, we move back down into value, that's good. But remember, once it moves into value, we want a couple days of sidewards movement, then a spike down, then a reversal. Well, what happened here? Is this a V2? It is, technically. Made a higher high, came back down into value, but what's wrong with it? Well, there's three things wrong with this. Remember, we never want to take a V1 or a V2 if day one is larger than one ATR channel. See this? Here's an ATR channel from here to here, from here to here, from here to here, from here to here. This is like two ATR channels. So that's strike one. It does, here's day one, day two does go lower than day one. It does wash it out. It does wash out into the value zone. But then day three, does it trigger? It does. But how does it trigger? It triggers above the 1 ATR channel, so it's a little bit too high. It gapped. So you have three things wrong with this. You're getting in front of a bar, that first day's bar or the first bar that's larger than 1 ATR. That's strike one. Strike two, I guess there's four strikes on this. Larger than 1 ATR, that's strike one. Strike two, there's no sidewards movement. Strike three, you do trigger, but you trigger over the 1 ATR channel. And strike four is that you trigger based upon a gap. And you can see for a couple days it did go, but it failed pretty nicely, right? So I do want to show you what can happen when you know your requirements are not there. All right, Visa. Okay. So let's take a look and see if this would have been a valid signal. Here we make a high. We come back down into the value zone, which is good. Then we attempt a rally, but there's no V1 or V2. Now we have a lower high above this. This high is lower than this high. When that happens, V1s or V2s are still okay, but we want to wash out that previous low. And so it's exactly what happens, right? If we had a V1, V2 that triggered here, great. But we had to move up, but it failed. So we want to take out that previous low now. We want to wash out those previous stops down there. So it does move sideways. We like that, right? The sideways movement is important. It's within the 1 and the -1 ATR channel. Then we have the washout day. This is day 1. Is day 1's height smaller than 1 ATR? It certainly is. So it means there's not a lot of supply coming in. So here's day 1. Day 2 washes out day 1. Does it wash it out by a 1/4 ATR? It certainly does. A lot more than that. Day 3, do we close above day 1's close? We do. Is it valid? Well, it did gap up, but see how intraday it went and tested and then reversed back up? So it nullifies that gap. So we have a move up, down, up a little, then we fail. These bars wash out this previous low, because when you have a lower high, you want to wash out that previous low that before you got to the lower high. Move sideways. Day 1, day 2, day 3. Day 2 washes out day 1. Day 3 does gap, but it tests the gap, then closes back above day 1 within the ATR channels. All good. And you can see that was a beautiful trade. All right. Hey, there I am. So anyway, I hope that helps everyone on the V1s and V2 entries. I can't thank Carrie Lavorne enough about teaching me about the V1, V2 entries. Are a huge part of my trading, and I talk about them all the time in my live stream. So if you're interested in contacting Carrie, this is his website, carrielavorne.com. His other website is spiketrade.com. That's the site that he has along with Dr. Alexander Elder. And I will post his information, his contact or his website information in the description of this video. So anyway, that's my presentation on V1s, V2s. I use them all the time. So, come join me Monday through Friday during the last hour of the market on YouTube. We look at this stuff. We talk about V1s, V2s, the context of the chart. We do this every day in real time. You can watch me trade live, make my entry and exit decisions, and I always explain, why I'm doing them. So, yeah, please join us. And if you haven't subscribed to my YouTube channel yet, please do it. It really does help out. And if you like this video, do me a favor and hit the thumbs up button. So anyway, I hope this is helpful. It's good seeing you. Thanks to all the people that come and watch the live stream every day. And if you do have any questions that I didn't answer in this video, feel free to email me with those questions. My email is in the description of this video here. And you can also contact me or send me a message on Skype at Gossett Trading, not Skype, sorry, at Gossett Trading on Twitter. So if you have any questions, please let me know. I'm happy to help. So thanks for your time. Thanks for watching. And on the way out here, got to play the U.S. government required disclaimer. So have a good rest of your weekend. Take care and hope to see you next week. Bye-bye. U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.